Today we're going to talk about M and W patterns and the 12 candle window. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Been a busy couple days in Perth and also spending a bit more time trying to put this together today to hopefully clarify some things for traders. A lot of questions about the 12 candle window, understanding the bigger picture. And again, we talk about keeping it as simple as possible, but beneath those simple layers it can get a little bit complex. And today hopefully we're going to clarify that a bit to help simplify your approach in terms of not trying to go to the screen each day and trade every move, but also just taking a big picture look at things and then having a thesis or a narrative each day when you go to the market, understanding what you're looking for, screening the pairs that you're looking at, whether it's 2 pairs, 4 pairs, 10 pairs. I typically follow the British pound crosses. This applies to any instrument that you're trading though. We talk about the big picture, we talk about structure, and we're going to go through some examples on some charts today to clarify the 12 candle window and the M and W patterns. So don't get too freaked out. We're going to use the whiteboard, but we're also going to look at some other examples to clarify this a bit further. So let's get started. We talk about structure, high of the day, low of the day, the timings, round numbers. So essentially they're in the simplest form each day when we go to the screen. We talk about a 3-hour window, and this is really important because the different types of M and W patterns that can form on any time frame. They can form over a day, they can form over a few days. We can get multi-session M's, we can get multi-sessions W's. For the most part today, what I'm going to focus on in terms of simplifying this is to understand each day when we go to the screen for London, New York, or even Asia, how we can look at the 3-hour window when they establish a high and a low for any session. In that first 3 hours, they will establish a high and a low. We've talked about this. We've talked about the importance of looking at that high and low, and then we talked about, do they extend the range in that next 3 hours? So oftentimes people will say, well, the box was 75 pips, my high and low were 75 pips. When they extend the range outside of the high and the low of that first 3 hours, we typically can be looking at possibly a type 1 if it's more than 25 to 50 pips. Type 1, we will be looking for the market to have extended out and give us some sort of peak formation, and there's different types which we're going to look at today, but if they move it upwards, we're looking potentially for a sell high signal. If they move it down, we're potentially looking for a buy low signal. Now, what's important though, and we're going to come back to this, is the structure. Because what we don't want to be doing is looking for a sell high setup 25 to 50 pips above that first 3-hour window if it's in an up template, because obviously we could be selling into an uptrend and vice versa for buying low in a downtrend. And this is really important when we come back and look at the big picture structure of the larger template that we're trading inside of. But essentially, a type 1 is when they move it outside of that Asia or London or New York, high and low. So again, if we have a high and a low in that first 3-hour window, we talk about 8 to 11 p.m., 2 to 5 a.m., and 8 to 11 a.m. New York Eastern Standard Time. If they bring it up in a down template or in a downtrend, we're looking for our sell high setup above the Asian range or London or New York. Now, if the market in a normal day, for example, we talk about the market in a contraction phase, they hit the stops, they might hit them again a second time. We saw an example of this yesterday on the pound yen and the pound Swiss, where they were in a down template, they brought it up high for the M pattern, and again there's variations of the different types of M's and W's, which we're going to look at next. This would be a type 2 if it's a sell high off the high of the day or a buy low off the low of the day. And then of course we have a type 3, which is when the market may have either worked its way to the low of the day range or broken out and pulled back for the sell high setup in a downward moving market, and vice versa for the upward W. We want to be buying low in a market that's potentially breaking out. We talk about descending triangles, ascending triangles. These show up in the Asian session a lot. So the other thing to consider, which is really important, is that they can link one session into the next. We could get a sell high setup, and then in the next session it may only come back 25 to 50 pips, and we may get a buy low setup to continue the move up, which is very important again while we talk about structure. You can link these setups into every 3-hour 12 candle window, which is why we often will have a market that sells off really hard, and in the US session they go back and stop out the trader who sold it off in London, because we'll get a sell high setup and we'll get a buy low setup going back in the other direction. So there's type 1, type 2, and type 3. Now we're going to look at some examples of that so you can see a clear drawing and on some charts of what they look like in real time.
Okay, traders, so here's some examples of the type 1, type 2, and type 3. Now, not every single day is going to match these templates, but these are the bulk of what will show up on most days and in a textbook situation on at least one or two of the pairs. Type 1 typically will extend outside of the Asian range and give us a sell high setup on our 15-minute charts. And again, similar with the W formation, we will get a move outside of the Asian range and give us a W setup for the buy low micro double bottom or buy sell high micro double top on the 15-minute charts. The type 2 typically, which would be sort of a normal day where the market trades sideways within its consolidation, stays in that, heading into the Europe-London Open, we will get a sell high setup off the high of the day. Same thing in the reversal for the W rotation, is we will get a buy low setup off the low of the Asian range, heading into the Europe-London Open. And type 3, of course, is where the market heads towards the low of the range. Traders are looking for the W reversal, and it's actually a selling low setup, which is a sell high in the new session for a big move in the downward direction. Often this will catch traders off guard. They're looking for the reversal off the low of the day. And this again is where we talk about looking at the big picture structure. Same thing with the reversal pattern, the higher W at the high of the day. And again, this is where you can see the ascending and descending triangles. Now, the other type 2 version would be a rectangle, basically a sideways market where we get the sell high setup off the high of the day and we get a buy low setup off the low of the day. And again, the type 1 is where there's a breakout or an extension of the range and traders are chasing this. And the key with these is to not be counter trending the underlying real directional trend. Now, the exception to this rule would be if this was the high of the week or the low of the week. These typically will show up at high and low of the week setups, sometimes on a Monday, Tuesday, for the reversal back in the other direction, and that catches traders off guard because they think they're counter trending the overall trend, but it's a new template now and they're reversing the market. And here's some variations of how those M's and W's can present. We'll often get just a straightforward textbook type of M pattern, but we can also see an extended M pattern, which again we will often see in that type 1 setup or at the high of the week, low of the week type situation where the market is extending out, and often we'll see 3 levels of rise, 325 pip increment moves as we head into the next session. So this is often an extended out market that will give us the extended M. And of course the short formed M can appear at the high or low of a day when the market is jammed in. It's got traders already caught up top after a stop hunt. They'll push one more time into the peak formation where traders have maybe already shorted the market for the continuation back with the trend. Same thing with the W reversal. Straightforward W, this would be very common in a type 2 situation, and sometimes in a type 1, but more common probably in a type 2. And again, the short form W often will occur at the low of the day after the market is stop hunt at a low and pulling back and going into consolidation. This is a very common area to see the short form W, and the extended W is often what we'll see when the market is going to reverse for a stop hunt in the other direction. So we often will see this at the bottom of the London session. They'll push one more hour down and reverse before extending back up and reversing up into the next session. So really important to study these three types of patterns, because it's not always going to be just a textbook straightforward M pattern or a textbook straightforward W pattern.
Okay, so hopefully that made more sense. Now, we could be looking at a 12 candle session. I don't want to call it Asia, London, or New York. We could say this is any session. The market could trade in a normal situation, hit the stops and do an expansion and trend. Then we could get a three-peak formation in the second 12 candle window, and there's our M pattern. So we had a W pattern that broke out of the box after we hit the stops and we hit the stops. Then we get a three push pattern. The market pulls back. We can get a retest and a sell off now for a move back to the low of the day into the next 12 candle window. Afterwards, we can have the same thing happen now. We could get a short form W formation for a move back inside to go into consolidation. So again, we can link those three types of M's and W's into one complete session. They can be linked together through each session. Now that's just an example of how a market can trade throughout the day on one type of day.
And an example of a day where we see multiple patterns show up, where we have a sideways consolidation, the market extends out slightly just prior to the Europe-London Open, and we get a type 2 M formation, an engulfment, and a move down outside of our geometrical pattern for a measured distance before having an extended W formation at the low of the day in that fourth hour after the Europe-London Open. We get a move back through into the high of the day into our next 12 candle window, and we get the extended M formation and an engulfment, which is a three push pattern, and a 1, 2, 3 to the high engulfment reversal before pulling back into consolidation and then closing the day out with a short form W heading into the rollover session.
Now the next thing that we need to consider, and again going back to our structure, is that if we're in a market that's in an uptrend, and each session we may get, if this was a day 1, day 2, day 3, in an up market we could still get a sell high setup, because even though that may be a good trade, we could get three pushes down in the reversal W for the trend trade. So it's important to remember this every time we see that setup. If we're in an up market and we're expecting a buy low, but they come out and give us the sell high setup, you have to be aware that now you could be potentially selling into the trend. So then of course we're looking for the buy low setup, and if that happens in the gap time between our 12 candle windows, of course if this move's already in place, in the next session of course we're going to be trading with the trend. That's what's really important. A lot of the patterns when they set up may be counter trend to the bigger structure and the underlying real trend, because they're trying to trap traders into the trend before they reverse the market and do a measured move in the direction of the trend. Now typically on day 2, level 2, I always look for the trend trade, because that's the day that the market will continue to trend, and trend traders will usually pick that up because they're using indicators. It follows all the trending indicators without any problems. The issues can happen though when we get into level 3, because of course this market potentially will whipsaw traders back and forth and catch trend traders up high before stopping them out, catching them again, then stopping them out before coming back into consolidation and potentially reversing. We've talked about how this can often show up with the Fed, often level 3, and they'll spike both sides before reversing the market. Now the next challenge with level 3 is that often traders will assume that this is the beginning of the downward template, which it may be. So we'd be looking for sell high setups in a downward template as opposed to buy low setups in an upward template. But in some cases, the market can fool us and continue that upward move, which is why sometimes we'll get a reset, we'll get a peak formation low perhaps, or a creeping trend down for a day before the market resumes its trend. But in a true up and down template, the market will usually come back underneath for the move back down, which again is why we'll often get buy signals going back with the trend to trap more volume up high before they shift the market. So I hope that makes sense. But those three types of M&W patterns will show up every single day. It doesn't mean you're going to see a W every time the market makes a low, and it doesn't mean you're going to see an M every time the market makes a high, because they may move it up and reverse it. Now on some smaller time frame, a 1 minute, a 5 minute, there may be a micro double top or a micro double bottom. But on our 15-minute charts, if they're making you chase the trade, A, it just may not be setting up properly for us to execute a playbook setup. And number two, it just may not be the best day for trading. It may be they may be consolidating volume, and it might be choppy and a bit messy, and they might be working volume into a peak formation, but it may not be a nice clean chart for trading, which again is why we look at the 6 pairs, or whatever, if you want to look at the euro, whatever pair may be setting up properly for you to get an ideal trade setup. So just coming back to looking at risk reward as well, we talk about the bigger picture structure and geometry. We could have a head and shoulders pattern in here. We could have multiple days. We could have 3 days. This could be one session. This could be 2 days of volume up high. But depending on the size of the structure, we'll often target at least 1 times that distance as a measuring distance for a profit target. For a ascending triangle, again, we'll target 1 times that distance as a target. And same thing for a descending triangle. We'll look at 1 times the measuring distance of that pattern as it comes into its fruition. Now, we talked about, not because this may actually be 100 pips from numbers to numbers before it breaks out, as opposed to taking 50 pips. You may be in a trade now that's going to go 100 or 150 pips, which again comes back to if we're in a big rectangle and we get a breakout and a retest, and you're already in London or New York or whatever that is, again, we may be looking at a measured move of that structure. Often this is a great example of where the US session can come underneath of a break of a range in London. Traders are looking to buy it back up when they're caught in a measured move now of a move at least 1 times that upper rectangle distance, which is why we try to look at the big picture each day of structure. If we're in an up template or a down template, and sometimes the easiest way that I think about that is Monday's day 1, Tuesday's day 2. And often, sometimes what you'll have is you'll have a Friday here and a Monday here and Tuesday here. So we're in day 1 and they go back up again to the top in Tuesday. And of course, if that's the case, Wednesday can be a trend day. Or day 2 can be a trend day if we were the same way the other way. If we had a Friday, a Monday, and a Tuesday, where we break out, we pull back, and we continue the move. These are some of the things that we're trying to look at each day when we're in the big picture structure, so that we can look at our risk reward to determine if we have a measuring target bigger than 50 pips, if the market continues to trend and we are in a sell high or a buy low setup for a strongly moving market.
Okay, just another example of the big picture structure and some of the variations that we will see. This can happen over several days. This can happen in one session. This can happen over multiple sessions through the day. So again, the bigger picture structure, looking at geometric patterns that will show up not only with our, sometimes just in our 3-hour window. This could be an Asian session. This could be a London Asian session. This could be Monday, Tuesday, Wednesday. So you get the idea that these structural patterns are important because they give us a geometrical shape that we can target for measured distances, as opposed just to randomly shooting for 30, 50, 40 pips. We can start to take a look at the bigger picture and capture the bigger moves if they start to develop these structural patterns. And again, just looking at the examples of measured distances that we can use or extrapolate for potential measured moves and profit targets, as opposed to just randomly going for 50 pips, because some of these moves in bigger geometrical patterns will be 150, 250 pip movements, and the market, depending on how explosive it is coming out of these patterns, will move there very quickly or whipsaw back and forth. And again, depending on the type of setup, the longer the time frame, the more likely the setup will complete. Again, just a couple of variations of triangles and some examples of how markets will trade and break out. We'll often see this in Asia. We saw an example of this yesterday on the pound Canadian. Ascending triangles, Asian box, this would be the type 3W. A descending triangle, very similar to a type 3M pattern. But again, they'll break out and continue the move often. And this can happen in any session. We could have a build-up between Asia and London for an ascending triangle breakout. This can happen at the bottom of a day. They could come down and go sideways and form an ascending triangle, and same thing vice versa. We could get this at the top of a day. But you get the idea. We're looking at bigger geometrical structures when the volume gets trapped and the market is potentially going to shift that for a measured move target.
Okay, so just reviewing structure, really important. The high and the low of the day. Every time our session starts, we redraw our highs and lows because they will change throughout the day, but we have our bigger structure and our directional bias in place unless the market gives us a clean setup for a counter trend trade that would be potentially 50 pips or more. But if we're in a trend trade off the high with a downtrend or off the low with an uptrend, we potentially could be looking at 50, 100 or more pips with that market. So we work from the high and the low of the day. The timings are critical. If you want to trade at other times, there's nothing wrong with that, but the 12 candle window often will be either a completion or a continuation of the move or the beginning of a major move for 50 or more pips, depending on where we're at in that template and what type of version of the market they set out for us that day. So we could be just in a range bound market if the market's trading sideways that day. Even it may be in a pause for a day or two after a couple of big moves. Timing's critical. Round numbers, most of these trades again will work back and forth off the numbers, 50s and double zeros particularly. But the timings are critical. This reduces your screen time. It allows you to focus on one or two high possibility setups. Stick to your best playbook type setups with those M's and W's. Timings are critical. We talked about the hourly rotation, but remember, they set the high and the low in that first 3 hours. If they extend it outside of that range, that's when we can start focusing on a type 1, a type 2, or a type 3 setup for either a move back with the trend or a move back counter trend to stop hunt the high or low of the previous session. So hopefully you got some value from today's video, traders. To simplify that, it's not just as simple as if it breaks the top we're looking for an M, or if it breaks the bottom we're looking for a W, because you don't want to get caught against a type 3 move that's going to go a measured move with the trend in the opposite direction. And that's what they do to margin out traders' accounts. So stay disciplined, traders. Stay focused. Keep it really simple. Focus on the big picture, and may the markets go with you.
Just an example of a normal day. We have an Asian range that consolidated back inside of the high and low, traded sideways. The market in London hit the stops. They came back down. They hit the stops. They pulled that back into consolidation after an engulfment before continuing that into the next 12 candle window breaking out with another engulfment following through. But we have our, again, if we just squeeze this, we see our bit of a W formation, but the market breaks out of its rectangle for a measured move distance of that geometrical shape. Just an example of a normal sideways day where they hit the stops, and eventually trend the market. An example of a false break reversal taking out the previous day's high, but it's also a multi-session extended M pattern that pulls back inside, extends the range in Asia, giving us an engulfment and breaking through the low of the day. We have a potential geometric descending triangle now to target, and we get a type 3M not only at the end of the Asian session, but into the Europe-London Open as well. So again, traders looking for the reversal, it breaks out, they're looking to buy back in and counter trend the market when they're caught in a bigger geometrical measured move in a downward moving market. Hopefully they're looking for the sell high, the type 3M descending triangle. And again, that market continued into the next day. An example of the market moving 50 pips prior to the Asian market opening and then consolidating. So we often have traders say, well, if it moves more than 50 pips in Asia, I don't trade it. Well, it's irrelevant. It's all the same. The market goes into consolidation and then gives us a type 2W at the low of the day for a move back up towards the high of the day. And then the market goes into consolidation and gives us an M pattern for a stop hunt back on traders who were long on the W before pulling back and reversing in a 3-push type 2 M formation at the high of the day and an engulfment in our 12 candle window for a measured move back through the low of the bigger rectangle. So again, you can link these variations of M and W's from session to session because you're going to see them connect, and every 3-hour window will give us a high and a low, and then the market will either have already painted a structure or is about to paint one heading into the next 3-hour window. So if we look at some examples just from this week, we can see the pound yen. On Monday, we had an Asian session high and low. It went into consolidation, giving us a rectangle inside of the range before breaking out in the London session, the Europe-London Open, pulling back, dropping down, pulling back, and then dropping down for what would be a type 3M formation, and then breaking out, pulling back into the US session 12 candle window for again a continuation of a type 2M. Type 2 is high or low of the day, and when we redraw our highs and lows, we see that this gave us the engulfment short for the move to continue through the US session. The next day, we see the market pull back from the US session, going to consolidation, and hit the stops before consolidating sideways and giving us a type 3 formation, a type 3M formation. The market moved more than 50 pips from consolidation, hit the stops and reversed, and then dropped down, pulling back and extending the range in the extra 3-hour window heading into the Europe-London 12 candle window before pulling back, dropping down, pin hammer, and on a smaller time frame we would have a type 3M formation with a descending triangle for the measured move down. We get to the low of the day, and again similar, we would have a short form W formation, not completely filled out on the 15-minute, but obviously on a smaller time frame we would have the same version. But you can see the pattern is there at the highs and lows of our 3-hour window. It doesn't matter what time frame, what session. When that high and low has been established, the market will then go into the next phase of either extending that range for a continuation or giving us a reversal formation with one of the W's or one of the M patterns. We head into Wednesday's session. Yesterday we have a high and a low in Asia. The market stays fairly range bound before expanding prior to the Europe-London Open, hitting the stops, dropping down, hitting the stops, dropping down, pulling back, and extending the range out. We get a 3-bar reversal, not really a textbook M or W, but then we get our type 2M formation pattern at the high of the day in our 12 candle window at the US session open. So again, just no matter what day it is, what pair it is, we're going to see a variation, little variations of these patterns, but if you're following multiple pairs, you're going to be able to pick one of these up. M's and W's will show up every day on these pairs, but it's important to understand the variations and how they can present in different forms, and then also looking at the big picture structure. So if we zoom out, we can see that we're trading in a downward direction currently on the pound yen. After being in an up template for last week, the market broke out of that upper box, and again we can take our measuring tool because now we have a rectangle formation in that high and low, and we're currently targeting a measured expansion. We've already gone outside of that, but the peak formation low has been hit, and if the market was to continue to trade through that, we possibly could get a measured move of the larger structure as well. And that's just again coming back to nothing's guaranteed, but we try to look at the bigger picture to see if there's opportunities for us to take a bigger profit target if the market is moving strongly with geometric patterns for measured moves. So hopefully you got some value from today's video, traders. Keep it simple. M's and W's. Study those three types of variations of the different M's themselves, but also the three types of M patterns that can show up out of every 3-hour, 12-candle session into the next session. Have a great trading day, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.